Today is April 5th, and all of the data and the dividends for the previous month have just finished coming in, and I want to share all that with you guys in today's video, as well as some potential changes I'm considering doing in my portfolio. So come along for the ride. I hope you guys enjoy. If you do, like, subscribe, always greatly appreciated. And let's do this. Okay, so over the past 30 days, my portfolio is essentially flat, up 0.63%. In comparison to that, the S&P 500, my benchmark, has price movement of 0.55%. This is a quick bird's eye view of my portfolio. It consists of three traditional indexes, VOO, VGT, and SCHD, and then three hybrid covered call funds, DIVO, JEPI, and BST. I have made some purchases over this past month if I filter by deposits and withdrawals. This month I made 4 separate deposits, and I tend to make deposits when the market goes down. I like to take advantage of that. Most of these deposits were in the middle of the month, and coming back to the price history of the S&P 500, during this time period, the market was indeed selling off a little bit. And if we zoom out year to date, it was during this time right here. Now, when it comes to my income, usually DIVO, JEPI, and BST are the main players because they pay on a monthly basis and have a much higher dividend yield. But because this past month was March, all of these names paid a dividend. So SCHD paid me a quarterly dividend of $61.60, VGT $18.73, and the S&P 500 $34.48. So not massive dividends considering this is paid only every 90 days, but it's a welcome addition. And if we take one of these names like VOO, this is the long-term dividend history from this specific investment. As you would expect, as I make additional deposits and the payouts grow, my dividend amount is also increasing. We can do the same thing for ticker SCHD. And this is what that looks like for me. After these names, we have the monthly payers, and DIVO for the month of March paid me $30.30. I haven't bought a significant amount of this fund for quite a while, and that's just because DIVO has been outperforming the market over the recent history. So during most of 2022, I've been buying names like VGT as they've been coming down in price. It does seem like this trend is changing, and now technology stocks are becoming more expensive, relatively speaking. So I might soon pivot back to buying more heavily into funds like DIVO as the trend kind of changes. So my share count in DIVO has remained relatively constant, and here is the monthly dividends I've been collecting from this investment. We also have BST, the BlackRock Science and Technology Trust. They paid me $54.43. Now, BST is a closed-end fund with managed distributions. You can see here that for quite a while, it's been consistent at 25 cents per share. So that's why the payouts in my portfolio is remarkably consistent from this investment. Aside from right here, my dividend went from almost 30 bucks to almost $50, and that was in October of 2022. So right in this time period is when I bought more of BST, and so far that seems to have been a good idea. So that's all of my dividend income for the month of March, minus JEPI. Annoyingly, JEPI is always the last to pay their dividend, but they did declare what it's going to be. And that dividend for the month of March is 45 cents per share, slightly more than the previous month of 41 cents. And when you combine that with the amount of shares I own, that's about $58. So that means altogether in the month of March, I had $258 of dividend income, 66% more than the previous month. But a better comparison would be a month like December, where we had $239 of dividend income. So we're definitely slowly and steadily moving in the right direction. Also, the value of my portfolio at the end of March was $48,034, which is 8% higher than the previous month. Now, as promised, I do want to cue you guys in on my latest thoughts when it comes to my portfolio management. So I view these 3 ETFs as the core of my portfolio. We have VOO, SCHD, and VGT. These are my 3 favorite ETFs of all time. VOO via the S&P 500 gives me broad market exposure to the US equity market weighted by market cap. And then these other 2 names give me a little bit extra exposure to market segments that I like. The only drawback of these 3 ETFs, in my opinion, is the yield is not that impressive. Combined between these three, the dividend yield is like less than 2%. So that's why my current strategy is to augment these names with a comparable higher yield covered call fund. So for VOO right now, that's JEPI in my portfolio. Again, that's based off of the S&P 500, but it has a much higher yield. For SCHD, I have DIVO doing a very similar thing. And then over here, BST focuses on technology companies with a covered call overlay strategy. And I really like this strategy I have developed here. I have broad market exposure while still having a bit more concentration in the areas that I want. And of course, I have a much higher overall dividend yield of about 5%. My only complaint with the secondary investments I have here is the fact that they're all actively managed. And to me, that's always going to be an inherent negative versus a broad market index. So as a compromise here between the passive indexes and a higher dividend yield, I keep coming back to the name XYLG. This would fulfill a similar role that JEPI currently fills in my portfolio. It's based off of the S&P 500. It has covered calls. The yield is, I think, 6% right now. But unlike JEPI and more like VOO, this is systematic. So it exactly follows the S&P 500 index and writes at the money covered calls on half of it. And that's it. Very simple, and there's very little active management involved to mess things up. So simply in terms of methodology, I'm a bigger fan of the approach of XYLG versus something like JEPI. But the question is, does this translate to better or at least competitive performance? So we're looking at the total return of XYLG in orange, the S&P in blue, JEPI in purple, DIVO in this green teal color, and K&G in red. And my takeaway here after evaluating lots of these different graphs is that on the way up, XYLG captures most of the return of its index. It's exactly what you would expect, which is something I'm looking for. And then during sideways and bear markets, these funds can close the difference and catch back up to their index, if not even surpass it during these times. So again, these funds aren't going to have extreme market beating returns, but compared to the complicated financial derivatives of JEPI and the active management team of DIVO, I think the reliable returns of XYLG along with the consistent monthly income is valuable. Yes, that's why even though JEPI right now is way more popular than XYLG, I keep wanting to invest in this ETF. Now it is important to know that XYLG isn't alone. There's also QYLG, and the latest edition is actually TYLG. And this one in particular, TYLG, is extra fascinating to me because it would fit in the growth side of my portfolio very nicely. Now, TYLG literally just has the technology sector ETF within it, and then the other half you see that has a weighting of 55%. The rest of it has those covered calls on it. So I have been thinking that maybe instead of XYLG, I sell BST and replace that with TYLG. It has about half the expense ratio as BST, and it's way more predictable. And if I do that, then maybe I can keep JEPI in my portfolio because I don't want to have two ETFs from the same company following the same strategy. I like to be diversified across multiple companies. But I certainly want you guys to leave a comment letting me know if you agree with my logic on these funds from Global X. Do you think the systematic nature of the covered call strategy is important, or is JEPI just as good? And between these funds, XYLG, QYLG, and TYLG, which one do you prefer most? But with that said, I hope you guys enjoyed. If you did, like, subscribe, and I'll see you guys in the next one.